Good day, ladies and gentlemen. Welcome to my YouTube channel. As you can see by the title, we are going to be covering the tax implications of non-residents and the double tax agreements that South Africa has entered into with other countries. Let's get straight into it. Let's take a look at the learning outcomes. At the end of the session, you need to be able to define the terms resident and non-resident. You need to be able to discuss whether a natural person is a resident or non-resident for income tax purposes. You need to be able to calculate the South African tax liabilities, including withholding taxes, exemptions, rebates or deductions for foreign taxes. And lastly, you need to be able to apply the provisions of tax treaties or double tax agreements that South Africa has entered into with other countries. Let's take a look at this example. Will Goodwill works for a large privately owned South African construction company, Perfect Construct Solutions, also known as PCS. PCS has clients in South Africa and in a number of foreign countries. Will is a highly skilled technician, and in November 2019, the decision was taken by PCS to send Will to a construction site in Mauritius to assist with the completion of a project for the construction of an industrial building for a Mauritian client of PCS. Will left South Africa on the 15th of December 2019 and commenced working in Mauritius at the client's construction site on the 2nd of January 2020. PCS does not have a permanent establishment in Mauritius. It was agreed between PCS as his employer and Will that he shall return to South Africa at the end of May 2020. Will's monthly remuneration amounts to 85,800 Rand. He's concerned about the taxing implications of his remuneration earned whilst working abroad. He does not know whether he'll be subject to South African income tax or Mauritian income tax, or perhaps even double taxation on his income earned whilst working in Mauritius. Now, in terms of Article 14 of the double tax agreement between South Africa and Mauritius, subject to the provisions of Article 15, 17, 18, and 20, salaries, wages, and other similar remuneration derived by a resident of a contracting state in respect of an employment shall be taxable only in that state unless the employment is exercised in the other contracting state. If the employment is so exercised, such remuneration as is derived therefrom may be taxed in that other state. Number 2, notwithstanding the provisions of paragraph 1 of this article, remuneration derived by a resident of a contracting state in respect of an employment exercised in the other contracting state shall be taxable only in the first mentioned state if A, the recipient is present in the other state for a period or periods not exceeding the aggregate of 183 days in the calendar year concerned, and B, the remuneration paid by or on behalf of an employer who is not a resident of the other contracting state, and C, the remuneration is not borne by a permanent establishment which the employer has in the other state. And 3, notwithstanding the preceding paragraphs of this article, remuneration derived in respect of an employment exercised aboard a ship or aircraft operated in international traffic by an enterprise of a contracting state may be taxed in that state. Now let's take a look at the required. Explain to Will Goodwill the tax implications in respect of his remuneration earned whilst working for his South African employer in Mauritius. Do not perform any tax calculations, but confine your answer to a discussion on whether his remuneration earned between the period January 2020 to May 2020 will be subject to South African income tax and or Mauritian income tax, or neither. There's an extra mark allocated to communication and clarity of expression. The total mark allocation is 9 marks. So how do you approach a question like this? Step number 1, you have to identify the residence status of the taxpayer. Is this person a resident? Is this person a non-resident? Now, the starting point for calculating a person's taxable income is to determine the person's gross income. This term is defined as follows in Section 1 of the Income Tax Act. Gross income in relation to any year or period of assessment means, in the case of any resident, the total amount in cash or otherwise received by or accrued to or in favor of such resident. Or, in the case of any other person than a resident, the total amount in cash or otherwise received by or accrued to or in favor of such person from a source within the Republic during such year or period of assessment, excluding receipts or accruals of a capital nature. Now, to summarize the gross income differences between the resident and the non-resident taxpayers, the resident taxpayers are taxed on their worldwide income. The non-resident taxpayers, on the other hand, are taxed only on their income from a source within the Republic. Now, who exactly is a resident for income tax purposes? We need to know who is a resident for income tax purposes, because we know that residents will be taxed on their worldwide income. Non-residents, on the other hand, will only be taxed on income from a source within the Republic. So who is a resident? Resident, in terms of the Income Tax Act, means any natural person who is ordinarily resident in the Republic or physically present in the Republic for a period or periods exceeding 91 days in aggregate during the relevant year of assessment, as well as for a period or periods exceeding 91 days in aggregate during each of the 5 years of assessment preceding such year of assessment, and for a period or periods exceeding 915 days in aggregate during those 5 preceding years of assessment, in which case that person will be a resident with effect from the first day of that relevant year of assessment. So there's 2 ways to become a resident for income tax purposes in South Africa. Number 1, you can be resident by being ordinarily resident in the Republic. Number 2, you can be a resident through the physical presence test. And the physical presence test requires the non-resident to be present physically in the Republic for a period or periods exceeding 91 days in the relevant year of assessment and 91 days in aggregate during each of the 5 years of assessment preceding such year of assessment, and 915 days in aggregate during those 5 preceding years of assessment. The term ordinarily resident is not defined in the Income Tax Act, and the interpretation given by the courts must be followed. In Cohen versus CIR, it was held that a person's ordinary residence would be the country to which he would naturally and as a matter of course return to from his wanderings. So if South Africa is the one place that you will always return to from your wanderings, then that's where you are ordinarily resident. Number 2, after identifying the resident status of the taxpayer, now we need to identify the source of their income. And perhaps let's go back to step number 1 to identify the resident status of Will Goodwill. Is Will Goodwill a resident or a non-resident for income tax purposes? And in my opinion, Will Goodwill was or is ordinarily resident in the Republic, and that makes him a resident of the Republic. Number 2, we need to now identify the source of income. Take note that this step is not relevant for Will Goodwill because he will be taxed on his worldwide income regardless of the source. Remember, resident taxpayers will be taxed on their worldwide income. Non-residents, however, will be taxed on income from a source within the Republic. Now, there are 2 ways to determine the source of income. Number 1, through statutory source rules contained in Section 9 of the Income Tax. The Act defines the source of a number of income streams, mostly in Section 9. These statutory source rules mostly deal with passive income, for example, interest, dividends, royalties, and etc. The second way to determine the source of income is through the common law source principles, or the case laws. If the source of a specific type of income is not specified in the legislation or a tax treaty, it must be determined with reference to case law. So, step number 1, we establish the resident status of the taxpayer. Step number 2, we identify the source of income. And there's 2 ways to determine the source of income. We will determine the source of income through, number 1, the statutory source rules contained in Section 9 of the Income Tax Act. And number 2, we will establish the source of income through common law source principles, or your case laws. Now, I've tried to summarize the source rules in terms of Section 9. Let's take a look at the summary. Now, for dividend income, Section 9(2)(a) states that the source of dividend income depends on the resident status of the company that pays the dividend. If the dividend is paid by a South African resident company, then the source of the dividend is in South Africa. So if you receive a dividend income from a South African resident company, that makes that dividend a local dividend if you are in South Africa. Number 2, interest income. Interest can be from a South African source on either of the following bases. If the residence of the person paying, so either in terms of the residence of the person paying the interest, or the place where the funds or the credit obtained is being used or applied. Interest incurred by a person who is a South African resident is from a South African source. Interest received by or accrued to a person is from a South African source if the funds or the credit are used or applied in South Africa. So that's how you determine whether interest income is from a South African source. It can be from a South African source on the following basis. The residence of the person paying the interest. So if the person paying the interest is a South African, then that makes it income from a South African source. Or if the place where the funds or the credit obtained is being used or applied is South Africa, that makes that interest income South African interest income. And interest received by or accrued to a person is from a South African source if the funds or credit are used or applied in South Africa. So that's how we determine the source of interest income in terms of Section 9 2B 1 and Section 9 2B 2. Royalty income. Royalty income may be from a South African source based on the residence of the person paying the royalty or the place where the intellectual property is being used or may be used. And lastly, disposal of immovable property. Remember, guys, this is just a summary. So you need to go and read Section 9. In terms of the disposal of immovable property, the point of reference is Section 9 2J, and it reads as follows. If the asset that is disposed of is immovable property, then the source of the amount is in South Africa if the immovable property is situated in South Africa. So if the taxpayer is disposing of immovable property which is situated in South Africa, then the source of that income, the source of those proceeds will be from a South African source, since the immovable property will be situated in South Africa. Step number 3. Now we need to identify the applicable withholding taxes. Remember, step number 1, identify the resident status of the taxpayer. Are you dealing with a resident? Are you dealing with a non-resident? Number 2, if you are dealing with a non-resident, you need to now establish the source of their income, because non-residents will be taxed on income from a source within the Republic only. So that's why you need to establish the source of their income. Step number 3, identify the applicable withholding taxes. Again, this is just a summary. Let's take a look at dividend income. In terms of Section 64 Cap E, the withholding tax rate is as follows. The beneficial owner of the dividend, generally the shareholder, may be subject to dividends tax on the cash dividends paid to it. The company that pays the dividend will generally be responsible to withhold the dividend tax at a rate of 20%. Interest. In terms of Section 50, the person who pays the interest subject to withholding tax, must withhold the tax from the payment of interest, and the rate is 15% withholding tax. This is on interest income. Royalty, Section 49. The person who pays the royalty must withhold the tax from the payment of the royalties in terms of Section 49E. The rate is 15%. Disposal of immovable property, Section 35A. This depends on the nature of the non-resident seller of immovable property. So if the seller is a natural person, then the withholding tax rate is 17.5%. If the seller is a non-resident company, then the withholding tax is 10%, and if the seller is a trust, the withholding tax is 15%. Remember, guys, these withholding taxes are applicable to the non-resident taxpayer. Dividends, however, the dividends withholding tax is applicable to both residents and non-resident taxpayers. Take note of that. Step number 4, we then establish the applicable exemptions. And in terms of the applicable exemptions, please refer to my YouTube recording on exemptions. I've put up a video where I covered the different types of exemptions that non-resident and resident taxpayers are subject to. And lastly, so this is the last step. Remember, step 1, you identify the resident status of the taxpayer. Step 2, the source of the income. Step 3, the withholding taxes. Step 4, the exemptions that are applicable. And step 5, the double tax agreement between South Africa and the other country. A double taxation agreement regulates how a contracting state will impose tax on income derived by residents of the other state. A typical double tax agreement will contain articles or chapters or parts covering various areas. Each country will come to the negotiating table with its list of conditions or must-haves, and the treaty that is ultimately signed is therefore the culmination of rounds of negotiations, compromises, and trade-offs. This is the reason why every treaty is unique, and the particular treaty must be referred to whenever an issue arises pertaining to the two countries. Excuse me. Now, if you guys wonder where you can get access to double tax agreements, they are available on the SARS website. So if you want to check out the double tax agreement between South Africa and Mauritius, you can just go onto the SARS website and you will find the double tax agreement. In a test or an examination, however, you should be given an extract of the double tax agreement between the two countries, as far as I know. So to summarize this topic, step number 1, you identify the resident status of the taxpayer. And your thought process should be as follows. Is the taxpayer ordinarily resident or resident through the physical presence test? If they are a resident, then they will be taxed on their worldwide receipts. And if they are a non-resident for income tax purposes, then they will be taxed on income from a source within the Republic. Step number 2, you identify the source of their income, and this is only applicable for the non-resident taxpayers. So in order to establish the source of their income, your thought process should be as follows. What are the statutory source rules in terms of the nature of the income that the non-resident taxpayer has received? So number 2, if the statutory source rules don't cover the type of income, then you ask yourself, what are the common law principles or what are the case law principles in terms of the income of this particular non-resident? Step number 3, you go on to apply the relevant withholding taxes. And you just ask yourself, are there any withholding taxes that are applicable for this taxpayer? Step number 4, you apply the relevant exemptions. Your thought process should be, are there any exemptions that are applicable to this taxpayer? Step number 5, you go on to apply your double tax agreement or your tax treaty. This will be provided in your question. Step number 6, which I haven't covered in this video, you apply the rebates or deductions that are available. This is only for CTA level. So you basically ask yourself, is there a rebate, also referred to as a credit, for foreign taxes on income? Is there a deduction for the foreign taxes on the income? And finally, you calculate the normal tax liability, or you go on to conclude if it is a discussion type question. Thank you guys so much for watching. Please, if you have any questions, if you have any comments, if you enjoyed this video, Please drop your comments. Please don't forget to give me a thumbs up. Thank you guys so much. Goodbye.